Welcome back. Now, TransUnion is releasing its fourth quarter consumer credit index today. Here to unpack and share the latest findings of the index are Geoff Miller, CEO of TransUnion, and Russell Lamberti, strategist at ETM Analytics. Gentlemen, thank you so much for making the time to join us. Perhaps, Geoff, let's just start off with the purpose of the index. Why do we do it, and where does this data go?
Yeah, I think it's, well, the reason we did it is because we think there needs to be basically an overall assessment of where the consumer credit market is in South Africa, how healthy is it, and that, gives a sense for, not where the economy is going. Obviously, our customers are banks and retailers and telecommunications companies, and they want to know kind of where things are going. And so, we partnered with ETM to try and bring that to the market.
Yeah, Russ, I was just chatting to one of the producers off air here, and we were talking about status of the South African consumer, and the general media response to the interest rate increase earlier this week was it's about $300 extra if you got a R1 million bond. But I look at my own social circle and I just get the sense that South African consumer is really under pressure at the moment. Maybe give us some context as to what your expectations are there.
Yeah, I think you're right. On the whole, it's important to understand, of course, that there's a wide array of consumers. There's different buckets of consumers, if you like, different income groups. People experience price increases, interest rate increases in very different ways, and so certainly there's a portion of South Africa, perhaps people who've gone too far in over their heads with perhaps unsecured lending, who are certainly under pressure. And I think there's a lot of your kind of middle to lower middle class income, middle income consumers that are just looking at, particularly in Gauteng, things like e-tolls, petrol prices going up, that are definitely weighing. And what an interest rate hike does is, at the margin, just exacerbates that effect a little bit. So certainly we're seeing that. But I think there is also evidence that there are certain sectors of this market that are actually doing okay. That people who are perhaps slightly higher income, who own home assets that have appreciated in value somewhat, who've paid down their debts. So it's not a blanket bad story for the South African consumer, and I think that's important.
Geoff, if we're to go back to the key findings, if you can talk us through them, one of the biggest trends that are coming out, what are these?
Yeah, I think there one or two things to take away from it. I think it did go up slightly. The index improved slightly, but not a necessarily great thing. So consumer debt or consumer delinquency was rising 13% last quarter on a year-over-year basis. This quarter it's rising 8%. So
right.
More people are not paying their bills, but it's less than it was last quarter. And I think a lot of that has to do with lenders have pulled back, and it's not just a recent event. They've been pulling back now for over a year. And so you're having less credit issued into the market, and so less new credit means less delinquencies, but there are still, especially in the low LSM sectors, there's just people that are underwater.
Why is it that the household cash flow situation has improved, but consumers haven't been able to pay off their debt? Why isn't there a correlation there?
Go ahead, Russell.
Yeah, perhaps just to say, I think that household cash flow is to the extent that we think it's improving, I think that it's off a pretty low base. I think people are under a lot of pressure. We saw in the fourth quarter the official inflation statistics showing that on the whole, necessities for households didn't actually increase in price by that much. But if we look forward, we're a little less sanguine on that outlook. We think that with the weak rand, with petrol prices increasing, we think that even food prices are going to just start to increase a little bit more. So I wouldn't read too much into the improvement in household cash flow. I think that if we just take a slightly forward-looking view, pressure remains in that space.
So how does the South African consumer in terms of debt compare to consumers around the world? Are we doing pretty well, or are we faring poorly? Because I read that some people have debt of up to 75% of their monthly income. That's staggering.
Well, again, I think there's you got to look at the broad array of consumers. There are some consumers, as Geoff has just said, that are underwater. Some people are so in over their heads that they're actually defaulting, and that they're going through a process of debt counselling and so on. But if we look at South Africa as a whole, true to our nature, we kind of seem to straddle the developing world and the developed world. Our debt levels at a household level aren't as high as they are in Europe or America or the UK, but at the same time they're way higher than our African peers, for example, and other emerging markets. So that's kind of where we are, which I suppose is where you'd expect us to be. But I think that households in the previous cycle did leverage up a lot, and since then have been spending a lot of time and effort trying to deleverage, trying to pay down their debt, some more successfully than others. So I think we sit with probably a two-tiered story here, where some people, as I said, have actually paid down debt and actually in pretty good financial position, and a whole section of the economy that's not. And that's the dichotomy we face.
What about the products that we are seeing sort of emerging in the market now that we have such highly indebted consumers? For example, like the consolidation of debts and loans in that kind. I mean, Geoff, to what extent are these good tools for consumers to latch onto if they're trying to work down their debt levels, as against just dealing primarily with what they have in front of them?
Yeah, I mean, it depends on the consumer and their, and I guess their financial discipline. I mean, the product in itself isn't necessarily a bad product, but what I would say is consumers that are used to 30-day loans, 60-day, 90-day loans, taking out a 60-month loan is a real big step for them, and I don't think they've necessarily understood that consequence. And also, let's be honest, it's at a very, very high interest rate, and many consumers don't equate or don't understand the interest rate they're paying. They only equate the monthly repayment amount that they have.
Right.
And so you have actually consumers that are taking out personal loans to purchase automobiles. And in my view, that's not a wise thing to do, because you can go get a vehicle finance loan at a much more attractive rate.
I mean, one of the things I find quite interesting, and I don't know, and to Russell's point about there being two very different economies, how much are you impacted by asset appreciation in things like the stock market? So we've get this great run in the market, but let's say it fell back by 10 or 15% over the year. Would that change your index much in terms of, I guess, the ability to service the debt and the outlook for them?
I'll let Russell answer that one.
Yeah, I think it's a complex question in a way, because so many of these things are interconnected. But a falling stock market wouldn't necessarily directly impact the index, but what you're likely to see in this phase of the cycle, and we've begun the process essentially, is interest rate hikes. That starts to cool the stock market down, and at the same time directly affects debt serviceability and affordability. And yes, there's definitely a net worth effect here that starts to impact perhaps the higher income groups, the stock owners, the people who actually own shares on the market. You lose 10 or 15% on your stock portfolio. That changes your net worth. It perhaps makes you less bold and bolshy to go out and perhaps borrow against some of your assets to buy your second home or whatever it might be. So that's very much that upper tier economy story. Further down, I think it's the second and third round effects of a falling stock market. So we perhaps go into a downturn, the stock market corrects 15 or 20%. That starts to impact certain companies, consumption and investment decisions, and so on. And the guy at the end who gets retrenched starts to come under pressure on his loan, and that's perhaps a 6-month, 9-month story after the market starts to move.
And how long does it take for interest rates to actually get to bite, so to speak? I mean, if you look at the 50 basis points, yes, it's $300 if you're on a $1 million loan, but how long does it take to bite, and then how long is it going to get felt by the index?
Yeah, I mean, it bites immediately in the sense that first monthly payment now is going to be reset.
Yep.
So we mustn't make any bones about that. That happens very quickly in the economy, but these second, third, fourth, nth round effects start to work their way through over probably 12 or 18 months. I suspect that a 50 basis point rate hike, if it were to just be that, and I don't necessarily think that is the case, but if it was to just be that, once it's worked its way through, would probably have quite a minimal impact on this economy at this stage.
Because remember, I mean, it's the individuals with mortgage bonds and with vehicle loans are the ones that are going to feel it. The consumers, that don't have those types of assets or that have taken out personal loans, going from 26% to 26.5%, it doesn't really impact those consumers. But so it's going to be a higher sums that are going to definitely feel it first.
Geoff, let's look at legislation. I mean, last year we had legislation coming through that seeks to further protect consumers from exposing themselves to more credit. Have you seen the effects of that legislation in the index?
I mean, no, not yet. I mean, the legislation, a lot of it has been discussion and it really hasn't been enacted. In fact, there are parliamentary hearings this week that looked at credit amnesty, that looked at changing affordability guidelines and a lot of other things. I'd say that the industry and the government is taking steps, positive steps, I think, around a couple things. One is garnishment, and they're looking at the garnishee orders that have been abused. They're looking at induplum, where actually your debt doubles, and where actually collection agencies can charge you to collect your debt. And they're looking at affordability, and I think all of those are very positive. But once again, it's not really in effect yet. It will become in effect, I would guess, probably in Q1 or Q2 this year. But I think a lot of it's positive. Some of it, we're not so supportive of.
Perhaps, Russell, just to throw one at you, I mean, speaking to Davi Root just before, just after, in fact, the interest rates had been hiked, he said that he was predicting that would be hiked again and perhaps right up to 200 basis points. Should that happen, one, obviously the consumers would be immensely under pressure. But how does this significantly change sort of the amount of risk and exposure that consumers are going to be faced with and the pressure that they're going to be under?
Look, if that scenario does play out, and I think it's plausible, a lot of pressure will come to bear on this market. There's no question. People have a lot of debt still. It's going to impact default rates, and that's just a historical fact. When you raise the cost of debt, the people who are servicing that debt, those costs go up, defaults increase. So I think that there's sort of two stories here. The one is the consumer story. The other is the producer story, the production story in this country. We've got a bit of a mismatch in this country, perhaps a big mismatch between production and consumption. We're running a 6% of GDP current account deficit. Government budget deficit is about 5% of GDP. Households generally use debt, corporates use debt. We need to get a bit of a better balance, I think, between production and consumption. We're in the same boat as countries like India and Turkey and Brazil. They're calling us the fragile five. Perhaps that's a bit overblown, but it's simply to say that we're countries that are consuming more than we produce, and that's got to balance out at some point. So unfortunately, we do have to take steps, whether it's through the interest rate, through fiscal policy, to start reining in that consumption habit. And trying to increase our production habits, if you like, to get a better balance in the economy. That'll support the currency, and I think will create a more, less vulnerable, volatile economy.
Geoff, are you worried? I mean, if you look at the 6 months down the line, what do you think we're going to be seeing 6 months from now?
Look, not a good sign that the government has already reduced their GDP guidance for the year and their forecast. But South Africa is going to grow this year, albeit at a very, very low pace. The banks have been pulling back for over a year now, so they're being very, very cautious in who they lend to. I don't see a meltdown. I just see continued stress, kind of bumping along the bottom, but no real positive signs that are going to say there's real improvement. Certainly for the first half of the year, if not the entire year.
And that is the outlook. And on that point, we'll wrap this conversation. That was Geoff Miller, CEO of TransUnion, and Russell Lamberti, strategist at ETM Analytics. Time now for Befriend the Trend. Befriend the Trend for today is the sharing economy. Firstly, Mark, let's start off with breaking down the concept and its potential for the South African economy. Okay,
so I was really impressed. There's a service called Airbnb, which is obviously the service which lets you rent out rooms within your house. I think Chris actually used it when she was overseas, and it's a really cool concept. You don't want to take on the risk of actually having somebody renting a full time, but you do want to be able to use your spare capacity and post your room on the internet and be able to rent it out for a couple of hours, a couple of days, whatever it is. And the concept is really cool. In fact, it's grown so much in the US that they're now doing the same service for dogs of all things, and that was actually just one of the trends that we looked at. People, instead of paying kennelry services, they now go and rent Airbnb for their dogs.
Well, before we get to the second part of my question, we do have a caller on the line. Hello, caller. Would you like to pose your question?
Yes. Hi there. I have a question for the gentleman there who was talking about the trade of the week.
Yes, he's right here, and you may go ahead.
Oh, okay, thanks. So, look, I think, because of Finwick, I started this investing thing, and I'm looking at adding some portfolio unit trusts or portfolio shares onto my portfolio. I've got one already. It's called Rebosis. But I was interested to hear about Capital Property Fund. So I looked it up quickly, and the share price has been pretty flat over the last year. I don't know how it's going to change over this year, over the next few years. I'm also interested in terms of how will the interest rate hike impact such stocks, because I listened to a lot of comments after the announcement, and a lot of people were saying that property will be hammered going forward. So I just wanted to know what sort of what that means. And lastly, just maybe a funny thing aside, and I was talking to some gentlemen who were saying that inflation is likely to go up, and when it does, there's a likelihood that even the e-tolls will have to go up. I just wanted to know if that's maybe possible.
Okay, thank you so much for your call, and especially your 3 questions. Let's first take the first 2 to Mark, and perhaps Geoff, since you're still here at the desk, we'll throw the e-tolls and inflation question at you. Mark, there we have Capital Property Fund. Gentleman wants to know the performance outlook. Why are you positive about them, but in particular the impact of interest rates on the stock?
Yeah, I mean, repeating what we said earlier, it's not great for listed property at the moment. I think fundamentals are still tough. The thing about Capital is that it's got very niche properties within its portfolio. The thing that with listed property at the moment, I think you can still get a distribution yield of between 6 and 8%, depending on which segments of the economy. If you're looking at it, capital growth on equities at the moment looks pretty poor as a short-term outlook. If you can bank 6 or 8% before you started, then that's not bad going after tax.
Not bad going after tax. Let's move on to inflation, Geoff, and the likelihood that this is actually going to impact on e-tolls. Do you cover e-tolls by any way when you look at the index?
No, we don't. We don't look at e-tolls. E-tolls aren't reflected in our database. We get information from the banks in the formal lending sector. I mean, from putting pressure on consumers, e-tolls will absolutely have an impact. Whether or not the weak rand and other things actually change what the e-toll rate is, I'm not a magician. I don't really know that. But I think e-tolls will make a negative impact on consumers, especially given all the other things happening in the economy.
Very quickly, Mark, before we go back to break, we're talking about the sharing economy. What are the successful business models that seem to work?
So Airbnb's taken off, and it's actually gone to the point where the traditional hotel services are actually challenging the idea that you can have the so-called sharing economy. I think it's quite disruptive by nature. Property rental is a very good one because it's something that you can naturally share. Business resources, business property space, there are a couple of options there. I think property and rental of property space is the most obvious and easiest to look at.
So it's definitely a trend that you think one should be befriending in South Africa?
I think that there are opportunities there. I think you've got to think like an entrepreneur and think on your feet if things are tough at the moment.